Time now to see what's on the radar for Gavin Graham, Chief Investment Officer at Spire Wealth Management. And Gavin, gold is up. It's been pushing $5,600 an ounce and continuing to be rallied by that weaker dollar and investor flight from sovereign. And you've been watching the metals. You've got some gold on your radar.
Absolutely. And again, firstly, the overall picture for gold is that what people have been calling the US dollar debasement trade. In essence, the present administration has made it very plain that they are happy to see a weaker US dollar because it encourages US exports and it reduces the demand for imports. And I believe that Mr. Trump said he was very pleased with what the dollar was doing as it was breaking down, having been off more than 10% over the last year or so. Mm-hmm. So gold companies are doing really well. Because you'll go, it's a store of value and a slight diversion. A gold fund manager in London back in the 1970s called Julian Baring said, let's do an experiment in terms of gold retaining its place as a store of value. It ought to be able to buy you a nice dinner at the Savoy Hotel. And in 1971, when he did this, it bought you an ounce of gold at $35 an ounce, bought you dinner for $3. Now an ounce of gold buys you dinner for $14, and that's with the price of dinner at the Savoy having gone from something like £12 to £470. So gold has a long track record of preserving the real value, and therefore companies which mine it usually do well when gold is doing well because they're leveraged plays, operationally leveraged plays. If the price of gold goes up, every additional dollar per ounce drops straight to their bottom line. So Alamos Gold has been one of the companies that has been looking very good. It's probably the premier mid-sized Canadian exploration production company. They bought Argonaut Gold 18 months ago, which had a mine literally the other side of the lake from their Island Gold mine, the Maginot mine. They've had one or two teething issues in sort of getting things up and running. And then, would you believe, Roger, again, the weather was pretty severe towards the end of last year. So their production for last year was about 550,000 ounces, which is a bit below expectations. As a result, it hasn't gone up as much as other gold companies, which means it's only up by 100% in the last year. The gold mining ETF is up 175%, but it's an excellent company. It's very well run. They're going to increase the production from the Island Gold site to over 400,000 in the next year or two. They've got a new mine coming in Manitoba called Lynn Lake. So all in all, we think this is probably one of the more attractive ways to play this.
And another one, they have another mine. I'm just looking up in Quebec. They just announced their drill highlights from them. I don't know if you had a chance to look at those. Is that reason for optimism? Drill highlights, 21.7 grams per ton over 5.25 meters. And same with, I can't pronounce, Kikavik?
Yes. Again, if you want one sort of obvious gold stock to buy, it's Agnico Eagle, which is the largest Canadian gold miner and is, one of the top three and has an excellent long-term track record of successfully bringing mines into production, but also made a couple of really good acquisitions with Kirkland Lake and the Canadian operations of Yamana in 24 and 23 and 24. So it is doing really well, and it's going to be the first thing that people buy when they actually say, oh, I ought to buy a gold stock because I don't own any. It always used to be that you would have, the Swiss bankers would say you should have 5 to 10% of your assets in gold simply as portfolio insurance in case of currency debasement. And, what's the first thing you're going to buy? Well, it's probably Agnico.
All right. And can we talk a little bit about, silver's just gone through the roof, but copper now, there's a big surge in China. A lot of speculative trading there, a little concerning?
Well, obviously, it is getting very frothy. And again, silver, which is sort of gold's wilder younger cousin, has gone absolutely through the roof, $100 an ounce, 150, and then straight back down again. But the fact is that you need quite a lot of silver in things like solar panels and industrial usage. And it's also shortage of supply. And copper is the same thing. Again, we touched on it briefly before the break in terms of you're going to need loads of copper for the electrification of the auto industry as well as AI data centers. And it takes at least 5 years to bring a new mine, if not 10 years. You can't just turn on the taps and get new supply. All of this is being reflected, especially with additional geopolitical uncertainty. And it's no longer just in time, it's just in case. You want to actually have access to supplies and maybe store some in case trade routes get interrupted. So all of this is pointing to needing to have a reasonable exposure to both precious and indeed industrial metals in your portfolio. And the great thing is for Canada, we've got a very big exposure there because we have the materials sector, both precious and industrial, is a pretty big part of the TSX, which is why TSX has outperformed both the Nasdaq and the S&P over the last year.